Welcome. My name is Allison LaForgia. I'm the managing editor of the content studio at HousingWire, and I'm very excited for today's webinar, The Great Mortgage Servicing Reset and How to Win in 2025. Today's webinar features industry experts and is presented in partnership with Sagent. Today's content will be led by Sagent's EVP of Servicing, Perry Hilzendager. Perry, the floor is yours.
Thank you, Allison. And hello, everyone. Welcome to today's mortgage servicing strategy session. As Allison indicated, the title is The Great Mortgage Servicing Reset and How to Win in 2025. I do want to thank HousingWire for hosting today's webinar and getting us all set up. You know, our goal is pretty straightforward. We would like to really share with you how you can prepare for 2025 through the eyes of some of the industry's very best leaders on our panel today. Before you head into the holidays, and I was going to say maybe relax in moving into the holidays, but we all know that in servicing, there's not a lot of relaxing that happens going into the end of the year. We know that you all charge right up to the finish and ensure that you're serving your customers, but hopefully this gives you a little bit of sense of, how some of the very best in our industry are thinking about 2025. Not only do we have the great panelists, but we have some great topics. So let's jump into the panelists themselves. Liz Valsay, Executive Vice President of Servicing for Carrington Mortgage. Earl Dunham, Executive Vice President of Servicing for Gateway First Bank. Dave Sheeler, Executive Vice President of Servicing from Freedom Mortgage. Welcome to all of you. Thank you for joining our discussion. I know your time is valuable any time of the year, but particularly at the end of the year. And we certainly appreciate your willingness to join us today and agree to share a little bit of your thoughts and insights. I am Perry Hilzendager. I'll be your moderator today, Head of Servicing for Sagent, and formerly Head of Servicing for Home Point Financial and Wells Fargo Home Mortgage. Again, great panel, very relevant topics. Some things we're going to touch on today. How to approach day-to-day servicing while also diversifying the business model and understanding how you can continue to serve your customers broadly. We're going to take a little bit of a look at the consumer financial health and their behaviors. They've come through a very difficult time period. We've seen inflation, we've had the pandemics. What can we expect going into 25? With any servicing discussion as it relates to mortgage servicing, cost always comes up. So we're going to dive in there a little bit. Technology strategies that these three leaders are deploying and looking to expand in their organizations. And we're going to touch a little bit on AI and how they're thinking about that in their organizations. Escrow change continues to have a significant impact on consumer affordability. And so we're going to dive a little bit there and get some thoughts from our leaders on how they're addressing that. Finally, we're going to talk a little bit about recapture strategies from these three leaders. So with that being said, I thought the best way to get this started is to hear a little bit from the leaders themselves and how they're working inside their organization. So each of them come from organizations that are experiencing success in mortgage servicing. They all come from organizations that also originate. They have very distinct models. I think that's one of the real genuine, strong emphasis of this group is they are all successful, but their models are all a little bit different. So we're going to ask them to share a little bit about their backgrounds as well as their business models. So in doing so, Earl, would you like to kick us off here?
Yeah, absolutely. Thanks, Barry. Yeah, so for those of you that aren't familiar with Gateway, we were founded in 2000 and we began our servicing shop in 2009. Our headquarters is located in Jenks, Oklahoma, which is a suburb of Tulsa. We have a couple of functions and a presence in the Dallas Metroplex with regards to our mortgage ops and our correspondent teams, but the majority of the servicing resides here in Jenks. Myself personally, I've been with Gateway for 10 years now and leading servicing for the past 4 years. When I began at Gateway, we were an independent mortgage bank originating and servicing in 40 plus states. However, in 2018, we set our sights on acquiring a bank, and we completed that acquisition in May of 2019. So today's Gateway's mortgage division originates in 42 states, and the bank's footprint consists of Oklahoma and North Texas.
Oh, thank you. I appreciate that.
Hey, Earl, I I thought I was the only one that was crazy enough to take over a servicing platform in the middle of the pandemic, but apparently you and I
Yes,
have
sir.
a similar background.
Yes, I love a challenge.
My name's Dave Sheeler. I'm a senior executive vice president here at Freedom Mortgage. I've been with the organization just coming up on 11 years. I started here running our correspondent lending organization and moved over into servicing, running both correspondent and servicing starting in 2020. Freedom is a full service independent mortgage bank. We have a large correspondent organization. We buy bulk MSR. We do co-issue. We do flow MSR transactions. We have a wholesale division and a call center organization. So really try and span the entire spectrum of mortgage lending, with the exception of retail, traditional retail. So we actually have gone through some pretty significant growth over the last several years. We started our in-house servicing platform in 2014, and have continued to grow from that point. Back when the pandemic started, we were around a $200 billion servicing shop. We have really taken advantage of the opportunities in the market. And today we sit at, we'll end the year at about a $640 billion servicing shop.
Liz, want to share a little bit about yourself and Carrington?
Sure thing. I have to admit, I came into my role right before the pandemic, so I'm not sure which is worse. You guys agreed to it. I thought I was getting one thing. I had all these lofty goals for 2020. By April, they had all changed. So I've been fortunate enough to work for Carrington Mortgage Services for 14 years, leading servicing for 5 of those years. So again, end of 2019. But I've really gotten to watch the company evolve over that time. Carrington came into existence when we bought the servicing rights to the New Century platform. So day one has taken kind of a high touch approach to servicing, especially around loss mitigation options. But we've really transitioned our portfolio to being 80% Govy out of our non-agency roots. Still do plenty of non-agency in our origination side, so a little bit of everything, but 80% Govy, and really just focused on servicing our customers and investors through specialty servicing. We've additionally created affiliate companies in areas where we've previously outsourced to have control over as much of the servicing and lending process as possible, and ending the year with a servicing portfolio of about $160 billion.
All right. Well, thank you. I appreciate the backgrounds from each of you. As I indicated earlier, we've brought some of the very best together, and you can hear it from their backgrounds and their experiences. And yes, they've had an opportunity to lead through some of the bumpier times in our industry's history. Some sounding like they got into it just before, and others right dead smack in the middle of it. So jumping in head first. So let's shift here a little bit to talk about the consumer health and what you all are seeing. And one of the things that I find about mortgage servicing industry is it's actually one of the areas that many economists look towards in determining the overall health of the consumer and understanding, how are they doing with their mortgages? Are they looking to refinance? Are they looking to upgrade? Are they buying? And we know that consumers make up, some 2/3 by most standards of all economic activity in our country. They've been resilient. They've come through the pandemic. They've gone through the post-pandemic. We moved into more recent components where inflation spikes have been prevalent. Home affordability challenges continue. So the question remains is, how much more can they take? What's the condition of the U.S. homeowner consumer going into 2025? So Liz, I was hoping you could share a little bit of what your perspective, is in looking at your portfolio and what you're expecting, from the consumer as we enter 2025.
Sure thing. Look, predictions are dangerous, right? But here I go anyway. So I see 2025 as a year of stability, right? There's absolutely consumer pressure out there. And while at Carrington, we've seen a slight degradation in the portfolio performance, it's not yet the gloom and doom that people are discussing. Again, I do understand that there's consumer pressure, but right now, consumers are still prioritizing their housing over other items. If you look at housing inventory is still markedly lower than it has been over the past 10 years, while up from its January 2022 lows. Housing starts have stayed in a pretty tight range over 2024. So while in some areas, for example, where I live, it seems like there's a new housing development popping up overnight, regularly, we're not in danger of the marketplace being flooded with new housing units. So I really, again, I'll probably live to regret this, but I really see 2025 as a year of stability, and think that right now, with the equity position most consumers have, they are prioritizing their mortgage and continuing to look for housing, continuing to enter the housing marketplace, moving away from being renters in many areas. Obviously, some highly expensive areas, buying simply isn't an option, but we're continuing to see more of the younger generations move into homeownership.
Well, that's encouraging to hear. That when I hear you say that they're prioritizing their mortgage, that wasn't always the case. Unfortunately, as some of us had the opportunity to be part of servicing through the Great Recession, we saw some people not prioritize the mortgage. It was not at the top, and I'm guessing. Do you attribute that mainly perhaps to the equity component? Is that where you would maybe see the differentiation?
I think it's two things. I think it's the equity component, and also in many areas, again, not all, the cost to rent versus buy. So look, you have some areas where, again, owning is still twice what renting is, but you have plenty of high growth areas where it is actually more expensive or the same to rent, or for what you would get for those dollars. Renting is a definite step down. But you're spot on. If the equity position changes, that consumers are going to react accordingly. I think there's also been some, I remember in 2010, people were absolutely going to prioritize their car payment over their mortgage payment. You've got a group of consumers who are remote workers or hybrid workers that maybe families are willing to consolidate down to one car. There's a little bit different dynamic to me than we saw back then.
Yeah, that's a really interesting point that you make. Is back when the car was the priority, it was because they had to get to work, and now because work is transitioning in many cases to home, it's like, hey, I got to have my home because it's my new office. So those are great points. Thank you for that. That was very, very insightful. Earl, I know in some of our conversations earlier, preparing for the event, you shared that you had a similar view on the consumer health, but you were also looking at contemplating some changes, and how your outlook on the 2025 health of the consumer was impacting your operations. Maybe you could share a little bit about that with the audience.
Yeah, I would agree, Liz, that there's, quite a bit of stability there. I do think that the rates will, they're still going to stay around the low to mid 6% rate. So I think that, the number of 6% is going to be the new norm. It's going to stick around. To me, I think the biggest impact is going to be on the new homeowners, the first-time homeowners. We've seen the median price of a house increase from about 320,000 in 2020 to now it's well over 400,000. So I think there's going to be some bond authorities out there that are going to create some opportunities, and folks need to be prepared to look at that, looking at the down payment assistance programs and things like that. But what we're trying to do, as we navigate 2025 in this environment, we're seeing a lot more borrowers take advantage of some of these loss mitigation solutions, which is great. But what we need to do in order to better prepare for that is to communicate better on how these borrowers are transitioning through these solutions. So we're making a big investment in really our communications plans. All that to say, our focus is really trying to communicate to the customer prior to them having to ask for a status update on where they are with their plans. So those are just a couple of things that we're doing to kind of help prepare for coming up for 2025.
So I hear what you say is that communication still remains sort of the pivotal, the kingpin, right?
It's key. You've got to manage the communications. You've got to manage the customer's expectations. You need to be giving them information before they have to ask for it. I think that's where you make the difference. We focus on white glove service is what we call it, right? Our LOs provide the white glove service at originations and closing, and then the handoff into our servicing shop is just the same. We try to provide that white glove service. So that's just, effective communications is key and part of that.
Do you find any mode of communication over another that is more effective, or is it sort of the blend of everything that is what really drives success there?
I think what drives success is really understanding the preference of the consumer, but having that offering, right? You've got high touch, low touch, medium touch customers. You need to be able to have that service offering so that you can, allow that customer to do business with you the way that they want to do business.
Yeah, that makes sense. Thank you.
Yep.
So the higher rates have been around for a while. We had very low rates for a very, very long time. And what it's done is created prepayment rate curves that, are vastly undulating, to say the least. Dave, maybe you could share a little bit about, what are you seeing in your servicing model with that based on where rates have been? And, we just heard from Earl, he thinks they're down a little bit, but maybe not going any further. And I'd be curious to hear kind of how you're thinking about it at Freedom.
Yeah, actually, I think I'm thinking about it very similar to Earl. I'll steal Liz's saying, like, I hate predicting, right? Because things can go in a lot of different ways. And I'll tell you right now, I think that there's more uncertainty in terms of where things are going to go as we head into a new administration, and they're going to have all their own policies. But generally speaking, when you really look at some of the policies the administration's laid out in terms of tariffs, and the impact that those tariffs can have, and some other policies that may impact the labor force, I don't necessarily see where we're going to go into an environment where inflation is going to continue to go down, or we're actually going to start to see deflation as opposed to inflation. So I think, for the immediate future, we're probably going to be in this higher rate environment. Now, where I talk about there being the potential to be very wrong on this is, there could be other policies, like if we're going to unleash energy in this country and, do more drilling than we've ever done. Well, oil permeates throughout the whole economy, right? Everybody just thinks about it as gas prices, but a lot of the products that are made in this country include oil, and a lot of the distribution chain is all about how much you spend to get things places, right? So, we'll just have to see where these two counterbalancing items play off against each other to see really, where we land around inflation. But any way you look at it, these things are going to take time to play out. So, that's kind of where my thought lies, that, at least through 2025, we're probably going to remain in a higher inflationary environment. and I want to get back to something Liz was talking about earlier in terms of the health of the housing market. One of the I think everything she was talking about is absolutely true in terms of, the supply chain and the lack of housing inventory. I think we are starting to see certain pockets, so everything I'm going to talk about is going to be from a national level, but there's clearly some pockets where things got a little overblown because a lot of people moved there during COVID. And, you're starting to see a little softening in certain regions, right? But when you look at the macro factors, the baby boomer generation's not going to age out of their homes until sometime in the early 2030s, right? So, you have a lot of people today sitting on 2.5%, 3% interest rates. And, when you start making decisions around, well, I'm going to sell my home, I'm going to move into something smaller, there's no economic benefit to doing that, right? To go from, I got my 2.75% rate and I'm going to go get a smaller home that's going to cost less, but I'm going to have to do it at a 6.5% rate. Why am I going to do that? Right. So you're really seeing a lot of people stay put where they are, particularly that aging generation that really doesn't age out for almost 7 or 8 years from now. Now, I do think we'll have a correction before that. I think, real estate also often gets tied in. All the asset classes of real estate get tied in together, and there'll probably going to be a correction from a commercial perspective some point later in this decade. But with that being said, we're still in an environment where we will see property appreciation for the next few years at the very least. So, even if we have a correction, you're probably looking at, people that are buying in 2023, 2024, they're going to continue to see appreciation, and any kind of correction they'll see probably won't be material. It's not going to be like the Great Recession, right? So you're still going to be in a pretty good position. If you're a homeowner, even if we see a correction later in this decade, we're still going to be in a pretty good position from where people are originating today. But when we talk about consumers, I think servicing in general, and Perry, tell me if I'm getting ahead of myself, I can stop talking and
The floor is yours, Dave. Keep going.
I always think about servicing as painting around the corners, right? So when you look at the financial health of our customers today, it remains very strong for all the reasons that we were talking about. The economy continues to be robust. There's fantastic loss mitigation options for customers in order to recover when they have a bad period. But what we really need to be emphasizing and concentrating on is those customers that are kind of on the fringes, right? And the ones that have used all of their partial claim funds, the ones that inflation's hit the hardest, right? When you look at credit card balances, everybody's credit card balances are going up, and delinquencies in that area, as well as auto loans, like all those delinquencies are rising. So from my perspective, when we talk about the financial health of the consumer, it's not necessarily the guys running down the power alley. It's the people that are having other struggles in their lives and have certain headwinds in terms of their escrow's gone up, their credit card balances have gone up. And I know we'll talk about escrow more later, but really kind of continuing to think back to Earl's point around communication, like how do we really drive our communication and, know your customer and understand the headwinds that your customers that are going to be most challenged are facing, and find ways to help them earlier in the process.
You made a really good point about the economic pressures being real. I had just seen a stat of fast food industry is seeing declines. Now, not every, location or chain or whatnot, but consumers are making challenging choices. It just, from what we're seeing, they're still largely choosing their home with the assistance of, you're right, fantastic loss mitigation options. But we're definitely, again, seeing consumers making choices and those choices are hitting other industries. So we'd be naive not to be aware of and watching them closely.
Yeah. And to your point, Liz, I think there's also, like, when you dissect it by vintage, it's different, right? You know, individuals, first-time home buyers, to Earl's point, as well as, you know, people that may have moved up in that 23, you know, late 2022, 2023 period. They came in at the higher interest rates, right? They were at a 6.5 already and a 7%. So I think those are areas where you got to pay, you know, more attention to your book, because they already bought into what was already accelerated appreciation at a higher interest rate. So
higher rate and higher price, absolutely.
yeah,
I agree.
So that's a great overview. I mean, what I hear you say is in general, the health is good, but there are pockets that are starting to experience some pressures based on inflation, based on maybe the type of product they got into initially. Some of them are starting to maybe get a little too levered up, right? We've got, you know, car loans out 84, 96, 120 months to create affordability. Credit card balances are at a historical high. I think I heard the other day 1.3 trillion. And we had just crossed over 1 trillion last year for the first time ever. So that doesn't seem to be slowing down. And what I hear from the group almost unanimously is that communication is key, right? Understanding. Is there anything else that you'd point to, you know, for the audience? Understanding that communication sounds like it, you know, getting in touch, understanding your customers. Is there anything else you'd share in this area with this group? Because that's a complex picture that you just painted for everybody, right? We're good overall, but be cautious, right? There's some things coming at us. Anybody have anything they'd add to that?
So one of the things that I started in 2024, trying to look down the road, you know, very little is going into default today, which I think is a big positive. Like, our whole mission is to keep people in their homes, right? But as some of these pressures start to mount in terms of people's ability to afford their home, be able to get additional loss mitigation, which some of those policies may be changing, there unfortunately will be an uptick in the area of default. Now, that may not come till 27 or 28, but thinking about how your organization, what your default organization looks like today, and really getting prepared for what unfortunately could be a 3 times or 4 times the numbers that you see now, it's important to make sure that you have the scalability in an area like that, and that you're prepared for the future.
So maybe a really good loss mitigation technology platform would assist you in this area. I might know somebody. We can talk.
That along with knowing your data and analytics. I mean, to drive the point here is, if you're not looking at your current pipeline in your book of business and understanding, you know, what loss mitigation solutions, or where the customer is in their you know, decisioning. You know, if you haven't used all your partial claim, there's still some left. You know, we're experiencing about a 54% redefault rate within our loss mitigation solutions, and so we're looking at the data and analytics to understand how many solutions are left and trying to forecast maybe where they're coming at the end of the pipeline. Right.
That's helpful. All right, great. Thank you for the additional info. So as I indicated, what would
One more thing on that I think is really important is also ensuring that a customer knows their current position around their house. You know, the more servicers can do to educate customers of, hey, you have 200,000 in equity in your home, you're going down a path of, you have no partial claims left, you know, these loss mitigation solutions may not work for you, you have a 2.5% interest rate, if you can't use partial claims, you're going to go to a 6.5% interest rate, is that affordable? Like, the last thing you want to see is a customer eat up their equity if they don't have to.
Yeah, and those are hard conversations, but as you guys have all indicated, I mean, that's the key with the communication, understanding the data, and making sure that the customer is making an informed choice. So I couldn't agree more. Thank you for sharing that. So we'll move on to cost to service, because as I indicated, what would a conversation on mortgage servicing be without it? We know that this continues to be an area of focus, no matter the cycle we're in, whether it was the Great Recession, the pandemic, inflation. We're always being asked to find ways, to be more efficient and effective in our operations. Liz, can you share a few things about what you're doing at Carrington to address this specifically, and then in doing maybe even include in that is how you're leveraging some of the technologies to assist you in this space?
Sure thing. And I'm sure like the others on the phone or on the call, we've put a lot of work into our metrics around cost of service, into our data, to really see where our costs are shifting, changing. But to your point, technology is an area we focused on quite a bit at Carrington from a couple avenues. One, the pandemic really changed consumer behavior, and we've worked to ensure we're aligned with those consumer expectations. So you had people like my parents, not just that generation, but even friends of mine who tended to shop online only for certain products and in early 2020. But by now they expect an online presence for everything they do, right? It's not just, oh, they order this one thing online. And so they do expect that across the board. And you've got the younger generation coming in by homes who have lived their life online. So we focus quite a bit on web development, which is short-term expensive, long-term beneficial from an employee or compensation standpoint. Additionally, we've done a lot with training, because it means the calls we do receive are going to be more complex. And if we can solve them the first time, again, it's more efficient, better experience, but also, let's be honest, also cheaper. From a technology perspective, aside from web development, we've also, Perry, hopefully you know this, we've partnered with Sagen on the claims product, right? So we're 80% Govy. Claims, default liquidation claims is a time-consuming and expensive process. And so we've spent the last couple years really partnering tightly to ensure that now we're in a position where we've got a lot of first level QA review being done through a system that literally was done by a person up until this point. And so we can rely on our human or manual review. It's still there, but to a much lower extent than we were previously. And for every Govy servicer out there, claims is an area, again, where you make one mistake that could result in not being reimbursed your advances that you expect to be. So that's been a very big one that has taken a lot of time from both sides, much appreciated, but is really a big gain for us in efficiency, even with the lower number of default liquidations, and is going to pay dividends as those default liquidations increase in the future, whenever that is. And then the other one, again, is just like doc ingestion, to ensure that again, we can remove as much of the manual element while keeping a human quality assurance element or QC check in there, but moving away from 100% of the work being done manually. Those have been the big things for Carrington.
It's helpful. Well, we've enjoyed working with you on that component as well. So it was a great partnership. Thank you for that. Dave, I've been in several conversations with Freedom, and we never miss the opportunity to talk about ways to help your organization be more efficient. Maybe you can share a few things that you guys are working on in this space.
So again, I'll reiterate a couple of the things Liz talked about. So like when I think about servicing, I think about it in terms of 3 C's. It's customer, it's compliance, and it's costs, right? And in a lot of ways, I think the customer drives your compliance and your costs. So You know, one of the things, or the big things that we've been on a journey of, is customer empowerment. So back to Liz's point, like, we've continued to build out and enhance our online experience for our customers, continue to drive more information onto our web and into our mobile. So, you know, that they have the tools at their disposal to really understand what's going on in their mortgage, right? Great example, and again, we'll talk about it later. You know, insurance or escrow has just become a really hot topic for customers. Well, you know, a couple of years ago, we changed the entire way that we displayed escrow for our customers. Something that's simpler for them to look at than, you know, an escrow disclosure, right? Oh, I get it. My insurance went up. But that empowerment is a really big one, but proactive outreach is another really big one. So, you know, we use the mobile app to push notifications to customers so they understand what's coming. We use every means possible. We use text when we can. You know, obviously there's some restrictions on that. You know, we do outbound phone calls. We've set up a outreach team that really concentrates on those customers with the biggest struggles, or, you know, and that really arose out of HAF, right? And having an outreach team that was identifying who could be helped with HAF, and how do we put together webinars? How do we put together, you know, Zooms and whatnot, so we can really talk to these customers and get ahead of the issues that they may be facing, right? You know, quality with your customer is going to reduce your costs because you don't have to have 5 phone calls with them. You know, to Liz's point, you can get it resolved in the first one. Or, you know, if they have an escrow change, and a lot of people don't read their mail, let's be honest, right? You know, getting out in front of them and making sure they understand that escrow change. So now you know, they're not sitting there on bill pay and sending you the old payment. They actually identify, oh, my payment changed, right? And you're dealing with a much simpler solution, and it drives, you know, less capacity for you, right? So the more you can get in front and help your customer with whatever's changing in their mortgage, and you know, our customers they're not all working in financial services, right? They're nurses, they're truck drivers, they're you know, managers of stores, and so you can't expect them to understand the dynamics of a mortgage the way we do. So it's our job to help them understand where the roadblocks are, where the potholes are, and help them avoid them.
That's, I mean, I hear the efficiency and, you know, not having the callbacks, right? So spend the time on the call the first time, or the messaging, get it right the first time, so you don't have to do it 4 or 5. And I think that's a change for our industry. I mean, I remember the days when it was, what was the average handle time? And everybody was so concerned about whatever it was, 410 seconds. And now it's more like, look, take the time that's necessary to address the issue and be done the first time. It's a better experience. And in the long run, it's a lot more efficient because you're not having to you know, readdress the same component. So
yeah.
That's helpful.
And one other thing that we do, Perry, is so not every issue is simple to fix and can be fixed in one call. So we have what's called, when we see escalating issues, we have a rapid response team that takes that loan off the assembly line, because those solutions are not simple. And you need somebody that can own that customer's experience end to end, in order to, and the time that one person spends getting intimate and helping that customer is significantly better than having them call in 10 times. So, you know, understanding what loans should go through the machine, because they're going to go through very smoothly, and understanding when a customer is facing a personal life challenge that's going to be more complicated, making sure that you're giving them that personal touch. Kind of to Earl's point, I think you called it the golden touch, or
white glove service.
White glove service. Sorry.
I like golden touch. I like golden touch. Maybe that's the new one.
Yeah.
So Earl, you mentioned earlier that you have your organization has gone through some changes on your model, some acquisition programming. I'm guessing that expenses come up in your conversation a time or two relative to that. Can you share a little bit about what you guys are doing there?
Well, yeah. So it's interesting. We merged with the bank, and so we've been challenged with trying to keep up with the agency change requirements, along with merging with the bank as well. So our servicing shop also supports the bank. And I mean, we've been building out our mortgage processes for years, and we've got them in a really good spot. But from the bank's perspective, that's a new book of business for us. So we're having to learn the bank products and learn how the bank customer behaves relative to a mortgage customer's behaviors. Similar, the expectations are the same, and that I think all consumers have a just a base level of expectation when working with any industry. But all that to say, yeah, we've from an investment standpoint, we're looking at how we can let the customer do a better job of servicing with us. It's a common theme, I think, throughout the industry. But what it's done for us is about 2 years ago, we completely rebuilt our IVR. Prior to rebuilding the IVR, we had a 40% containment rate in the IVR. So we knew we had some opportunities there. Well, we went through a project, set up a lot more APIs, put a lot more data in front of the customers. And so our average containment rate in the IVR in today's environment is about 70%. So that's been huge for us. The other thing that we're doing is we're looking at how we're doing business with our vendors. We recently looked at really the storage of our inactive loans. That's just one area that's just, I kept looking at it on a monthly invoice, and I'm like, we've got to do something about this. So we went through a loan purge process where we brought all of our inactive loans from the vendor in-house, and that particular initiative, that's a six-figure savings for us on an annual basis. So just re-looking at how you're doing business. And then Dave talked a little bit about, the kind of effective communications. We're doing a better job of diving into the analytics. Case in point, we've had, metrics on our repeat call rate, right? So this is just to see where we've got opportunities, if we've got broken procedures, if we've got coaching opportunities. What we didn't have is we didn't have a repeat email rate, right? You get an email, it's in writing, it's in front of a customer. We all know emails take time to go back and forth. And so I challenged the team to get me the repeat rate on emails just to see kind of what that looks like. And that's uncovered a lot of opportunities for us. Really in a servicing environment, we create these canned responses. Well, unfortunately, not all the canned responses answer the questions, right? And so we use this as an opportunity to figure out where we've got the opportunities and to do a better job of answering the questions the first time so that we're not repeating ourselves.
So it sounds like this has given you the opportunity to really leave no stone unturned, if you will, right? You've gone in and looked at everything. You've, storage, responses, things that may have worked in the past that aren't working today. So I think that's a healthy message to the audience to, take a look at everything. It may have worked before, but it isn't working today. So I'm sure the audience knows that we're very strategic with our topic lines, and it wasn't a coincidence that AI was right after cost to serve relative to how we're thinking about this wonderful technology and the impact. It's buzzing everywhere across the world. It's not just the mortgage servicing industry. Everybody's trying to get their arms around this area. It's creating a lot of excitement. I think it's fair to say that we're in the very early stages in all components. But particularly in mortgage servicing, most of what we've seen thus far in our industry is more in line with machine learning. Large language programming and usage is becoming, a bigger component. It's leading and opening the door to the real generative AI, which we're expecting to have significant impact. The process that's been followed here is we're in the learning stage. of AI. We're processing, we're utilizing the information. It's enabling us to begin to take actions to be more efficient. But that's where I think it really begins to open the door, and the true insights will become relevant to us with Gen AI, and it'll begin to drive actions, take the actions that today perhaps we're doing in a more manual component, but the human will play a big role there in ensuring proper controls are in place. I can share with the audience, I mean, we're doing this today at Sagent. As a matter of fact, in our engineering organization, we're utilizing AI in writing our programming. It's promoting greater efficiency. We have significantly less errors, and it's driving a much higher quality output. So I know the leaders here are spending time in this space as well. So in this segment, what we really want to share with the audience a little bit is, if you're using AI today, what benefits are you seeing from it? And then what are you hearing in other areas? Like, are others using it even outside of our organization? One that comes to mind is Salesforce and, the Agent Force programming. And then, finally, just, a bit of control and caution, what concerns them with the AI components. So Dave, do you want to lead us off here around a little bit what's going on with AI at Freedom?
Yeah, sure. Clearly we are exploring and developing certain pilots around AI. I will say, we're definitely taking a cautious and methodical approach to it, right? Because it's, there's a huge amount of potential with AI, but you also have to make sure you have really good controls around anything you do with it. In our case, I mentioned earlier, we have like 2.5 million customers. If you launch AI into a process and it doesn't operate correctly, you can do something wrong on 2.5 million customers. The way that we're thinking about it is, where can it continue to drive better quality for us? So, as we think about avenues in order to use AI in the near future, it's around things like QA. We're not necessarily looking right now to say, oh, we can do things that are customer facing, or move up, or automate a process. It's more around how do we get better and more detailed transparency into our calls. So using AI in order to do things like transcripts and look at, are all the appropriate things being said, and what's the sentiment of the call? Does this require a callback? What's the summary? So that's an example where it's going to change the nature of the way we're able to do QA, and the broad nature we're going to be able to do it. Whereas, today you can't build the manpower to listen to every call over again, or you'd have double the size of the call center. But it can really change items like that. Other ways that you can, that we're evaluating, but haven't necessarily gone there yet, is how do you use it from a data and analytics perspective and understanding the customer journey? Can you utilize it in order to really drill into the data? We all have the data of where are our customers going on our websites, right? Okay, well, if they're going somewhere on the website and then they're calling you 10 minutes later, like trying to get a better dynamic of what can I do differently in my website in order to make sure I'm answering their questions. It has a lot of long-term potential. And I think ultimately, we'll all get more and more comfortable with different ways to use it. But that's really the way we've been thinking about it in order to move very methodically through the process.
Yeah, that's helpful. I think we're still learning, as you indicated, and I like, where you're pointing towards, QA and improving other processes. Liz, when you talk about this at Carrington, are there things that you leave with the audience on just a cautionary basis? I mean, it is new, it's exciting. It's a little bit like Christmas when you open the new toys, right? So what is there anything you'd share with the audience that they should be at least conscious of?
Yeah, I think, look, we did a session at the beginning of the year. Carrington's executive management team got together, and we actually had a specific AI session with a professor who just absolutely fascinating. And one thing that I really had to get my head around is I'm so used to thinking programming language, right? Data analytics, we can program something to do that. And thinking of AI as the phrase this gentleman used was a somewhat naive grad student. And that you can trick AI, and AI can make up answers. They use the term hallucinate. I'm not sure if we're supposed to say this on this call, but they'll use that term unless you tell it, don't make up the answer. So these large language models are fascinating, right? They're so much fun to play with, but we are similar to Dave's sentiments. We are watching closely. We are looking at case law out in all industries. You know, we've seen some with drugstores, whatnot. We are looking at what lawsuits have come up, both state and federal regulations around it, to really try and get a handle on it. That said, we're doing a lot of testing now. Similar again to Dave, haven't really full-fledged unleashed it within the business yet, and certainly not consumer facing at this time. But that was the biggest thing that I had to keep changing my mindset on, was this is not a program where you put in this workflow and this is your end result. This is something very, very different.
Yeah, that's helpful. I mean, new technology, it's exciting, but the old phrase maybe, you get what you inspect, not what you expect, right? You still have to have the controls in place. And that was a common theme on a panel I was on recently, is everybody's very excited about it. We shouldn't be afraid of it. It's a new technology, not unlike other new technologies over the course of time. We just have to learn how to use it appropriately and be vigorous in our control on it and make sure that it's being done correctly. So Earl, we've touched on this a couple of times around escrow impacts. We're seeing pressure on payments. It's coming in the form of insurances are increasing. In some cases, carriers are dropping insurance. One of our employees here at Sagent, 30 plus years with the same homeowners insurance agency, never had a claim, was dropped because of, fire area, and, put them in a difficult position, ended up getting insurance from the state. Real estate taxes are under pressure because states and local governments are trying to balance budgets. Pricing is increasing. All of this leads to pressure on the taxes and insurance component. You'd shared in our preview that, you're taking some very unique but distinctive steps here to address this at Gateway.
Yeah, I'd like to start. I've got a couple of data elements here. So we also we manage lost drafts in-house in our escrow department, right? And so that's just an added bonus on top of everything else that's going on in the escrow world. So in 2024, we had enough. So there were so many natural disasters that occurred within zip codes that represent 43% of our portfolio footprint, right? So you've got to take that into consideration. And then, so the average homeowners policy has gone up 20%. The tax bill increases have increased year over year about 7%. So I think Dave talked about this a little bit earlier. So we at the beginning of this year, escrows have become one of our top call drivers into the call center, right? And trying to have that escrow conversation can be a little bit difficult, especially if your statement isn't bulletproof. And so we revamped our statement at the beginning of this year, which has made the escrow conversation, the payment increase conversation, a little bit easier because customers can really follow the statement a little bit easier. But when we get the customer on the phone, as much as we can, we're trying to educate the customer on, hey, you need to be shopping your insurance annually. I know it's a bit of a process, but in order to protect your position, that's just one thing that you need to be doing. The other thing that Gateway did is we entered into an agreement with a vendor who looks at property value assessments. And so our customers have to opt into this program If they opt into it, this vendor's model can predict whether or not the customer's property has been overassessed and may be likely to win an appeal. And so we have this offering. The vendor will, as a percentage of the first year's tax savings, can file that appeal for the customer, or the customer can just say, hey, no, just give me the data. I'll go file the appeal myself. So they have that option as well. So we've seen a little bit of success here. When we send these communications out, we copy our LOs on it. So it's a great opportunity for a recapture. It's a touch point for the LO. But it also shows the customer that, hey, listen, we're really trying to do things a little bit different. We understand what's going on, with your situation. And so, again, I think just trying to get in front of with these types of relationships, these vendor relationships will help us, right?
Well, as you can tell, Earl is a true professional because he closed that around the component of escrow being a recapture opportunity. I mean, first of all, those are outstanding examples. And I'd heard a little bit about the company that's doing some of the real estate challenges. That is very interesting. It'll be interesting to see what kind of success comes out of that, or if that begins to change even the models at the state and local level. But you really did hit the nail on the head. I mean, look, if somebody's payment is becoming less affordable relative to, the taxes and insurance, there clearly is an opportunity there for a recapture and a refi opportunity. So this continues to be front and center for servicers, the very best of them among this group, as a matter of fact, that have recognized the servicing team plays a huge role in the recapture component, not just with, creating a good customer experience, but also, recognizing when that customer has a need for a refi. We've seen some recent highs and spikes, third quarter, some 39%. A lot of that was driven by VA IRRRLs in Q3. So Liz, I know this is an area of emphasis for Carrington. Maybe you could share, is that what you've experienced, what we saw in the Q3, and then a little bit about some of the other products maybe you're seeing as opportunities?
Absolutely. Yes. Like the others, we did take advantage of that VA IRRRL pop and saw good results from that. So we were thankful to see that come through. We do have a second lien product that's doing very well from a units perspective since the rates have increased. Carrington's been highly focused on recapture since we created a lending division. And so a lot of that we've touched on with other topics. Big part of that is data, right? Of really looking at where we think we can help our consumer. Now, that's not always 100% accurate. Once we get them on the phone, we may think that they want to do a cash out, but in fact, they want to purchase another property, and being able to pivot once we know the actual customer's needs is important. But really strongly focusing on the data around our consumers, and then also the communication between servicing and lending. I actually spent a couple years in the lending group working on the data, the dialer, working with lending on our retail group on their recapture strategy before I came over to take my current role in servicing. And so we provide specialized training to our customer service representatives around possible benefits to the consumer. As Dave talked about earlier, we've got our IVR very well sectioned off to ensure that we're handling those people who we think we can provide a benefit to accurately. And then also on the LO side, providing some training around the servicing business. As Earl mentioned, once an LO has that information and can present that communication around, gosh, we see you had an escrow analysis and your payment increased, but it looks like we can save you money on a rate term refinance. There's a great intro there, and you automatically build that trust and rapport with your consumer. So it's really about the two pieces of the business working together, not just at the leadership level, but at the associate level to really expand that knowledge base.
It's helpful. So, well, we're at the top, but I don't want to end here. I feel like those reporters on the TV shows that always have to like close right at, with 10 seconds, but I do want to get just a contribution yet from Earl and Dave. If you could leave the audience with one thing on this recapture piece to say, hey, if you got some time, go look at this area or pay attention to this, what would that be?
My first is, again, I keep preaching data and analytics, just understanding, what segment of the portfolio could be becoming eligible for it, and making sure that the LOs have that data in front of them. We've got all the data in our system, so it's on us to make sure that, folks have that, in their hands so that they can do something actionable with it. And really, it's anytime you have an opportunity to plug an LO throughout the servicing, then offer that up.
I think the process isn't. It doesn't have to be overly complex, right? And I think we all do a lot of the same things, like we train LOs in servicing, and we all run the data and analytics to see where you actually have a great opportunity to save someone money. The one takeaway I would have beyond all that is don't prepare after the rates have already moved. You've missed the boat. You have to really think broadly around your organization of, if rates drop by 50 basis points tomorrow, am I ready or am I not? Because if you're getting ready after it's happened, you're done.
Ships left the dock at that point, right?
Yeah.
Yeah, great. Well, hey, first of all, I very much appreciate your time. Liz, Earl, Dave, you've been fantastic sharing your insights and your experience. I want to thank the audience for joining us today. And again, thank HousingWire for setting this and pulling this all together for us today. I wish you all a happy holidays. Thank you.